Once again, welcome everybody. My name is Fernando Parra, and I have the great privilege of being an assistant professor of accountancy at the CRED School of Business, where students prepare to become the next generation of bold, ethical business professionals. I also have the pleasure of serving as director of the Institute for Family Business, a comprehensive resource center for family businesses in our community, as well as a nexus to connect with our amazing students. As part of our mission to serve as an educational and resource center for family businesses, we are offering this seminar in collaboration with Wiebe Hinton Hambalek. We certainly appreciate their contribution to our members by sharing their knowledge. We also appreciate West Coast Industrial Solutions Magazine and the Fresno State Alumni Association for their assistance in promoting this event. Please stay connected with us on more information and resources for your family business by becoming a member and visiting our website at fresnostateifb.org. As you all know, the CARES Act provided economic incentives and relief for small businesses amid the COVID-19 pandemic. And the rules regarding the forgiveness of those loans have pretty much changed throughout the whole year. It is with this in mind that we are joined by both partner Frank Hambalek and staff accountant Colby Rogers to help us determine what do we know so far and how can we plan for 2021, help us minimize the tax liability and keep us in compliance with these rules. A little bit more about our speakers. Frank Hambalek specializes in high-level consulting and financial reporting work with medium to large-size construction and real estate companies. With his talent in management systems and people, he's served as an outsourced CFO for many clients. Other specialties include internal fraud prevention, GAAP standards, and the new leasing standards. Colby Rogers is a Fresno State graduate and a staff accountant at the firm. He has been with the firm for 3 years already. His background and specialty with family-owned businesses has been an important addition to this firm. So let me turn it over to you guys. Thank you so much and welcome, and appreciate your agreement to share this knowledge with our members. Thank you once again.
Thank you, Fernando, and welcome to everyone who joins us today. On behalf of Wiebe Hinton Hambalek, we are proud to serve in our community and give back in the form of some knowledge. 2020 has been quite an interesting year, not only for all of you, all accountants as well. Again, my name is Frank Hambalek. I'm a partner here at Wiebe Hinton Hambalek. Our specialty industries, agricultural, real estate, are our two main focus points. We not only specialize in tax and financial statement preparation work, but consulting in many ways for our clients' needs is what our forte is. Today, we hope to accomplish one goal, really is to share knowledge about tax planning opportunities based on today's rules, and then a look at and a peek at what could be around the corner, assuming President-elect Biden's tax plan comes into place. Along the way, you may want to entertain a question or two into the chat box. Feel free to add, and we will try to get to your questions either throughout the presentation or at the end. Fernando, just alert us if there's something that's come up that's on point, and we can go ahead and try to answer that question as we go. At this point, I'm going to turn it over to Colby for a few minutes to just remind us on some of the current established tax code. Go ahead, Colby.
All right, thank you, Frank. So some reminders for 2020, a lot of this stuff is the same from 2019. Some amounts might have changed a little bit, and all this information can be found in the tax planning guide provided. So we'll start out with the itemized deductions. The standard deduction has increased by $200. I think it's $12,400 a person now, and $24,800 for married. And then state and local taxes are still capped at $10,000. And you still have your charitable deductions. It's toward the end of the year. So if you'd like to make any donations to your local charities and get that in there, now's the time. We still have your meals and entertainment expenses. Your meals are still 50% to 100% deductible, and your entertainment expenses are 100% non-deductible. For bonus depreciation, that's still allowed. That allows you on qualified assets to depreciate 100% of that asset. So it's almost like you're expensing it. California does not comply with that rule though. So you will end up with some Fed to state differences.
Colby, I'll add a couple of things to that if I may.
All right.
On the bonus depreciation, I'll remind everybody through 2022, we're allowed to take 100% of qualified property as bonus depreciation. Starting in 23, there is a phase out through 2026 to where there will be no bonus depreciation in 2027 under the current tax code. Thank you.
Thank you. And then there's also section 179 for assets that aren't available for bonus. There are certain assets, and this allows you to deduct up to a certain percentage, so up to 100%. You can do any percentage. If you do less than 100%, then the remaining percentage will be depreciated as normal. And
let's remind the folks that up to $1,040,000 this year is the cap on section 179 depreciation.
All right, thank you. And then we've also still have the qualified business income, and that is, you have the deduction that is 20% of the qualified business income. And then we also do have your business net operating losses as well. And a 2-year carryback for farmers is still available.
I'll expand on that a little bit, Colby. Though this has been slightly changed by the CARES Act, and we'll get into that in a second, but generally the law was changed in 2017 with the Tax Act beginning in 2018. Business losses were only allowed to be carried forward, no 2-year carryback as prior to 2018. Also, there's a limitation on how much of the carry forward loss you can offset against future income. So in any taxable year in the future, you can only offset 80% of your income with net operating loss carry forwards. Therefore, there still will be some tax to pay. Typically in the past, net operating losses generated 0 tax due. So there was some balance between going from 0 to some payment of tax for net operating losses. To focus on agricultural, previously, prior to the 2017 Tax Act, farmers were allowed to carry back 5 years to get tax refunds for taxes already paid in previous years. Under the law of 17, that 5-year window changed to 2 years. Once again, we'll go over that in the CARES Act section of the program, as there was a significant change of these rules as a result of that act. Thanks, Colby.
Thank you. And then Frank, would you mind expanding on the excess business loss rules?
Yeah. So in the 17 Act, they wanted to limit your ability to take all of your losses related to a business if you're employed as or self-employed. And they wanted to cap up to $500,000 of losses to offset against other type of income. Could be wages, could be passive dividend income, interest income, and only to allow for a married filing joint couple up to $500,000. Though again, under the CARES Act, that was suspended as well, and so we'll delve into that in a little bit. So there are limitations on business losses. Not everything that you generate, God forbid that you had a catastrophic loss, in 2019, you were limited to the amount of that loss you could utilize against other forms of income.
Thank you. All right. So there are other business planning opportunities available, such as considering a type of entity for your business or possibly doing an accounting method change. And Frank will be going into each of these a little bit deeper.
Great. There was a lot of focus on this in last year's presentation to the group. And I just wanted to touch on a couple things, areas of focus this year to provide some guidance. And if you have any further questions, feel free to review our guide. There is some detail within the guide relating to choice of business entity. A lot of you small businesses are organized as a sole proprietorship. Sole proprietorships come with a lot of flexibility, taxation issues. And so there are some ways to reorganize your business, and choosing the entity that's right for you can be important for not only for tax purposes, but for legal liability. Partnerships are very simple to establish. General partnerships hardly any effort goes into forming a partnership. A limited liability company and a limited partnership, there is some organization you do have to employ an attorney to assist you in forming those entities. There are filing requirements with feds and the state of California. And there are franchise tax fees associated with your ability to gain limited liability protection. So the state of California does look for some fees, not taxes, fees associated with utilizing that type of entity structure. One of the items that was part of the 2017 Tax Act that Kobe touched on was the 20% qualified business income deduction. So as a sole proprietor or as organized as a partnership, you can still offset 20% of your earnings up to this year, let's see, 2020 is 326,600. So as long as you're below that cap, up to 20% of your qualified income can be deducted, reducing your taxable income and your overall tax liability. So remember that when you're doing your tax planning with your accountants, to factor in the potential benefits as a result of the QBI or the qualified business income deduction. S corporations are a little bit more of an animal to organize. Definitely will require legal assistance to be able to set up your S corporation. We do find one tax benefit that allows you to, once you reasonably compensate yourself with a W-2 wage, you can save earnings or on Medicare taxes that are usually paid with W-2 wages of 2.9% above your amount of wages that you pay yourself. You won't be subject to the Social Security limit or the unlimited Medicare tax at 2.9%. Let's go on to the next slide. One of the great changes of the Tax Act of 17 that you should be planning on if you haven't utilized this already and you're considered a small business. Small businesses in the past, before the 17 Tax Act, were companies of under 5 million in gross receipts on average of 3 years. Some businesses, 10 million as an average of gross receipts. As a result of the act in 2017, that threshold was bumped up to $26 million, which captured quite a bit of small business, not only in our valley, but across the country. So folks who may have fallen in that range of being accrual basis taxpayer in the past and paying tax on money that you haven't collected yet. I know that irritates a lot of our clients. But now with the $26 million threshold, a lot of folks now are reporting their income at cash basis. So you only pay tax on monies that you collect and deductions that you've actually paid for. Some of the other items that are now limited as a result of this higher threshold is you don't have to maintain inventory on your balance sheet any longer for income tax purposes, which usually was quite cumbersome for small businesses to maintain inventory. It's much easier just to write off into the income statement as you go. Some businesses were required to capitalizing some of their overhead costs into their inventory. That's no longer required. So just remember, these small nuances make a big difference. And if you're still reporting as an accrual basis taxpayer and you're under $26 million, you certainly want to bring this up to your CPA. It will make a difference in changing your accounting method. For contractors, typically on average of $10 million of gross receipts in the past, you were required to file a tax return that was based on the percentage of completion method. Rather cumbersome method of calculating your revenues to date on any contract that's open. Now, under the new method, you can just be cash basis. And so you have a much higher threshold to require yourself to go through that calculation. You're not subject to the new business interest limitation rules. That's quite a bit of benefit. The fact that you are a higher income threshold, there are new business interest limitation rules for accrual basis taxpayers. Again, now if you can get to that higher limit of reporting on the cash basis, you won't be subject to these business interest limitation rules. One caveat though to bring up, if you're part of many companies with common ownership, you are considered a control group. And so the IRS looks at the group of determining if you qualify for being a cash basis of that $26 million. For example, if you own 3 businesses, 100%, it's the cumulative total of revenues for those 3 businesses, not to exceed $26 million in average gross receipts for 3 years. Other than that, you're fine. And just some administrative note to bring up, there is quite a bit of work to change from accounting methods. Going from accrual to cash will require you filing for an automatic change, however, but it's still cumbersome to put the paperwork together. You have to work closely with your CPA to be able to accomplish it. It's especially if it generates a deferral of income as a result of the change, you will, instead of picking up all of that income that you carried in from the prior year, you get to carry it out over 4 years and really smooth out your income as a result of the change of accounting method. And sad note, California don't comply with any of these rules. So you have to really keep quote unquote 2 sets of tax books. Move on to the next page. I know I can't really get a show of hands. I'm hoping to hear that many of you took advantage of the CARES Act in many different ways. We're going to touch on a few of those today and hopefully can answer any of your questions that you may have encountered as a result of employing some of the great features of the CARES Act, but also to remind you of some of the key upcoming dates under the Act that you have to consider. And with a little bit of optimism, some potential legislation around on the horizon that may leverage off of the CARES Act that could add some benefit to you small business owners. Fernando, do we have any questions so far that we want to address before we transition in the CARES Act?
Not yet, but I will make sure that I volunteer a few.
Thank you. So I think it's obvious that we're in the midst of an awful pandemic, and Congress acted quite quickly, and the president signed into law in late March a package that was focused on trying to get immediate relief to businesses and individuals as soon as possible. We won't be covering every benefit. We're focusing on some of the business-related elements of the CARES Act today to just either refresh our memories and remind us of some of the things that we may have to do before the end of the year and or still take advantage of. So we noted earlier that out of the 17 Tax Act, there was a modification to, or there was a change to the net operating loss rules where we had to carry forward versus carrying back. The CARES Act relaxed those rules. And so what that allowed you to do under the act is immediately, even if you recall when this was passed in late March, there was some opportunities for folks who had losses that were generated in 2018 and 19 to go back, amend their tax returns and go ahead and carry back the losses to the open years versus carrying forward as the act, as the law change in 17 required us to. So that provided some, I wouldn't say immediate relief, but provided some relief to taxpayers to be able to utilize this item that's stuck on their tax return to be used at a future date. The spirit of the law was to allow you to use it today, and it's still in force for you to consider today. Remember, for 2020, the 80% limitation rules of utilizing the loss carry forward has been relaxed. You could utilize all 100% in the current period. We'll be talking about the PPP loan in a moment, but a lot of folks weren't really aware that there was an economic injury disaster loan available. The EIDL loan kind of partnered up with the PPP. When Congress passed the rule, the SBA immediately said, hey, you can get $10,000 as an immediate cash infusion, no questions asked. A lot of us took advantage of that. In addition to that, you could piggyback off of that $10,000 request and apply for a very low cost loan of up to $2 million, depending on your approval with your funding bank, for a 30-year SBA loan at 3.75%. So that became quite attractive to some business owners as an alternative to the Paycheck Protection Program. Some folks either missed the window to be able to get into the PPP loan process. And so this became an accommodation or an additional opportunity to find liquidity when banks were in a state of uncertainty at the time. I was quite aware that the banks had tightened up their credit policies because there was so much uncertainty that came into the marketplace after February and March. And so with the Fed stepping in and the SBA really stepped up to allow for the easy flow of monies that were appropriated by Congress. Next, the CARES Act cleaned up some legislation from 2017, which was a big hole, especially for small business owners who had what was considered improvement property. If you made changes to your building or prepared or made tenant improvements for either yourself or tenants if you're a landlord, found there was a loophole in the law that didn't allow you to write off or bonus depreciation those investments in improvements of years greater than 15 years life on these assets. And so with that, created immediate relief to those who invested millions of dollars before the pandemic and now during the pandemic to allow folks to invest in their businesses in the form of tangible improvements. Next couple slides, we're going to focus on tax credits. and then the PPP loan and forgiveness process. So we'll go to the next slide. So under the CARES Act, there were a couple of credits that became immediately available upon its passage for folks to consider. Remember, the impetus of the law was for employers to retain their employees, and Congress acted in many ways to be able to accomplish that. So one of the ways was to give you a credit up to 50% of $10,000 per qualified employee that you retained on your payroll. And so that became an immediate benefit to small business owners that were able to reduce their tax burden as a result of the COVID-19 pandemic. Many of us have dealt with either ourselves or our employees and employees' loved ones who've had to deal with COVID-19. So the act was enhanced to allow for an immediate reimbursement to employers who provided additional sick days and leave for employees who either had to take time off outside their sick bank for sick time and or to tend to a loved one. There are some limitations if you were the one unfortunately stricken with COVID-19. You were, employers were reimbursed up for 10 days at $511 per day maximum of reimbursement of employee wages. If a employee was out to care for a loved one, there is a benefit of up to $200 per day, up to 10 days for reimbursement to the employer. And that reimbursement is immediate as a reduction in the payroll taxes to be paid to the IRS on your very next deposit. Most payroll service companies have incorporated into their portals the ability for employers to report and made it seamless for all of us to be able to take advantage of reducing your payroll tax deposits if you are unfortunate to have some employees out on leave. Next slide. Some of the very large employers who were not able to take advantage of the Paycheck Protection Program loan as a result of their size of business, they were able to defer 6.2%, basically the Social Security tax portion of their employees, their employer share of the Social Security tax. So, you know, every month you would be making deposits at a minimum. And as a result of the change in the law, you didn't have to pay that over. However, it became a liability for you as a business owner that you will have to pay back during one half of it during 2021 and the second half in 22. We found a lot of the large employers in the Valley that didn't qualify for PPP wound up taking advantage of this deferral. Hopefully many of you were able to take advantage of the Paycheck Protection Program. Congress allocated $350 billion to be administered by the Small Business Administration. A qualified and eligible borrower, depending on the size and number of employees, can borrow up to $10 million. The amount of the loan was determined based on basically 2.5 months of your average payroll. That determined your loan size. The types of expenses on the next page. that you were allowed to pay with and receive a potential forgiveness for were to cover payroll costs, health insurance premiums, rents, utilities, and interest on certain loans. We found that most of the applicants that we assisted in preparing for their application for the Paycheck Protection Program had difficulty calculating their amounts. And so hopefully you were able to maximize the amount of the loan that you received, and that you were able to utilize all of those funds during a covered period of either 8 weeks or 24 weeks, depending on when you applied for your loan and how long it took you to pay for those covered expenses. I think on the next page, we continue on. So as mentioned earlier, you either were to expend all of the funds within an 8-week period. If not, there was a change or an update to the rules or law, an interpretation of the law that allowed us borrowers to go up to 24 weeks to be able to expend all of the money. There was a large uproar. Some folks were not able to spend all the money within the 8-week period. So the SBA came back and said, we'll allow for 24 weeks for you to be able to utilize the funds. Wanted to point out, when you applied for that loan with your banker and you filled out the SBA request, there was a certain loan certification that you, in good faith, were eligible to receive a loan due to economic uncertainty, and that you promised essentially to use the funds to retain your working force and to pay the types of expenses that were considered eligible covered expenses. There was a lot of bad press that came out shortly after the program and abuse, as with most federal programs. But there was a pretty good spotlight shined on those folks who either should not have either received the loan or did receive the loan and used the monies for purposes other than the covered expenses that were listed. So the certification became a very big play for the government to be able to put some hooks in folks if they did not utilize the funds as intended, and the penalties and potential criminal prosecution was available if that happened. Next page.
May I ask a quick question in reference to, I think a lot of family businesses always felt that, you know, should I take the loan or not? Am I really being affected? In some family businesses were affected moderately at the beginning of the pandemic, and they were not sure if they would qualify. That was one of the biggest questions. Well, what does that mean that I was impacted? Should it be that I lost 5% of my revenue, 10% of my revenue? And then some other family businesses were impacted by, you know, not being able to bring back their employees. So there was a lot of interpretations to what did it mean to be affected by the pandemic. Also, whether you should have the amount of funds that you should be requesting, whether they should be limited by your expenses for that 1 year, or could those expenses be
regarding a particular loan number,
I guess could be spent across a couple of years or so.
Okay, great set of questions. Let's expand on that a little bit. First of all, with respect to I'm hearing some background noise. Potentially not everybody's muted.
I'm not certain. Yeah, I'm not certain. It could be the line of credit. It could not be. I have a loan number and.
Thank you, Fernando. With respect to eligibility and folks questioning their ability to qualify for a loan or take a loan under the program. So there wasn't much guidance, and the SBA did try to clarify every week or so. They were issuing FAQs, frequently asked questions, that us borrowers were pummeling them with, trying to get clarification. Do I qualify? Do I not qualify? What do I use it on? And what they ultimately came back and said over several FAQs was that, you know, at the moment in time that you filled out the application, you signed it, and if you had uncertainty. Now, they didn't define specifically if you had a reduction in revenues. It was more, well, it's uncertain what my revenue stream will do in the future. It's uncertain if I'm able to keep my employees that I currently have on hand employed because there's so much uncertainty going through March and April. And so what the government was looking to do was really entice you to keep your workforce in place and pay your bills, utilities, rents, and the like, pay your loan. And so there was no hard, fast rule that said I needed to see a certain decline in revenues, or I needed to lose money in the stock market, or I needed to lay off all these folks because I didn't know how I was going to make payroll. And so essentially, if you started to feel that there was an amount of uncertainty, that was enough for you to become eligible to apply for this loan. And if you could remind me your second follow-up question, I can focus on that.
Sure. Some of the other questions that come to mind that originated from family business. One of them in particular was, you know, if I borrow all this money, I'm supposed to spend it exclusively on business expenses. Now, are those expenses meant to be executed or carried out in the first fiscal year of my company, or can they be spent throughout the next 3 years or 4 years? Is there a limit as to when we're supposed to actually use the money to be spent? And if that is the case, should we keep the money on a savings account, even though it's paying interest? You know, it's not free money, right?
Yeah. Okay. So you were to utilize the funds under the law is either an 8-week covered period or 24 weeks at the latest by December 31st. So the law was quite clear. It's a very short period, either 8 or 24 weeks, but at the minimum by, or the latest by December 31st. And to be eligible for forgiveness. Now, again, you try to want to get this forgiveness because the loan turns into essentially a grant. And so the focus and the incentive was to pay the covered expenses that we mentioned: payroll, keep your folks on staff, covered payroll, rents, utilities. However, if you didn't use the money for any of those covered expenses, the worst that could happen to you is that you're going to have a loan that's going to be paid back in 2 years. I hope that answered the question.
Thank you so much.
Very well. So with respect to forgiveness, so some of the things that we've encountered in assisting our clients in applying for forgiveness, we were quite successful in managing our clients through this process to encourage them to utilize the funds by the 24-week period on the covered expenses that were approved. And so I'm happy to say that despite the temptation to lay off folks, most small businesses kept their employees on staff and were able to receive some rent concessions, but also then made their rent payments because of the they wanted full forgiveness under the PPP loan program. And so what we found was that the key to the forgiveness is documentation. Many of our folks have worked with either their bank or a bank that accepted them under the program, and that the paperwork has been a necessary evil to be able to accomplish the forgiveness. And so as an example, what has been requested and what has been provided, the successful forgiveness applications that I've witnessed, all tax return or tax filings during the period. So your 941s and your DE6s and DE9s, the state of California, those provide proof and evidence to the SBA that you actually did pay your employees. Copies of your lease agreement and payments for rents. And so it's not only do they want to see a statement, they want a copy of the check. If you paid with it with a credit card, they want the credit card statements. So we found that the servicers of the loans have been very thorough and very detail oriented. So our recommendation to you today is provide all the supporting documentation that you have associated with each of these covered expenses so that you're eligible to receive 100% forgiveness. Any questions at this point in time on the forgiveness process? Okay. So we're going to move to the next slide and focus on some of the potential pending changes that could arise as a result of President-elect Biden's tax plan that he published quite some time ago. I remind you that the current laws that are in place will remain current as we roll into 2021. It will take both houses of Congress and the executive, the president, to sign the bill into law. For example, in 2017, when President Trump became in the office in January, there was a long, drawn-out process to be able to get Congress to decide on the actual formation of the bill and to be able to decide what was going to be in the bill. And it wasn't until very late in the year, I believe it was December 26th or 27th, there was actually a bill approved by both houses and that went to the president's desk for signature. I bring that up because when that happened, hardly anything in the bill and the law was retroactive. So what does that mean? That means the current laws that are in place today most likely will be the tax law for 2021. It's only my understanding, and based on my research, has only been one tax act during a year where it was retroactive to the beginning of the year that was passed by Congress. So the likelihood that 2021 will be the same as 20 is pretty high, but I say that with a huge bit of caution and unknown uncertainty. So what we did here is we wanted to compare and contrast the current tax law to the proposed by President-elect Biden. Some of you may have heard, and it could be important to you as a result of, boy, we're getting a lot of background noise here on the screen. Corporate tax rates. Corporate tax rates were significantly reduced under the 2017 Tax Act down to a flat rate of 21%. Away from the graduated rates up to 35% prior to the 17 Act. As a result, President Biden has made it very clear that he wants to increase that 21% rate up to 28%. Currently, the top individual tax bracket, which starts at $518,400 for 2020, is taxed at 37%. Under the proposed plan, we would go back to the pre-17 Act at 39.6% for the highest bracket of tax being paid. But starting at, get this, the bracket starts at $400,000 versus $518,000. So more of your taxable income will be taxed at the higher rates under the proposed plan. A couple of good things for families. Child tax credits of currently at $2,000 per will increase to $3,000, plus an additional kicker for $600 for youngsters under 6 years old. Be a big infusion for families. Also, childcare credits currently at $1,050 per child for a maximum of 2 will go up to $4,000 per child if the proposed plan comes into law. This one is real interesting relating to Social Security taxes. So currently an employee will pay half of the 12.4 and the employer pays the other half of the 12.4. So we each pay 6.2%. And the first, in 2020, the first $137,700 is taxed at the Social Security level. Under the proposed program, the 137 will stay into effect, but those having either self-employed income or wages over $400,000 will begin to pay again the 12.4%. So the goal there is to gain or gather more Social Security tax on the highly compensated, and to leave those under $400,000 uninjured as a result of the change. There's a lot of talk about the capital gains rate, which is currently taxed at 20% for those who are selling properties or stocks. For those who have over $1 million of income under the proposed law, that 20% special rate would go away, and you would be taxed at the highest ordinary income tax rate of 39.6 on those items such as sale transactions of property and or stocks. This is quite important to most folks as well as the estate and gift tax threshold, currently at 11.58 million per spouse, will be reduced to 3.5 million, with lifetime gifts capped at $1 million. Currently, we have the ability to gift and utilize our exemption and our annual exclusion each year. We could utilize without filing gift tax return, if you recall, is $15,000. That'll remain in place, but you will have some limitation going forward on your total gifts that you may give to your children or heirs. So be sure to watch that and consult with your estate advisor with these potential changes. One of the big ones associated with the change in the proposal is that when someone passes today under the current rules, those assets are transferred at the valuation of the date of death. So if your grandfather passed on to you something that he bought for $100,000 and it's now worth 10 million, you're going to get a step-up basis as a result of his passing, and your value that you take that over at is at the $10 million value. However, under the proposed plan, the assets transferred will retain their original cost and tax basis. That could be a significant change in estate tax planning. Currently on itemized deductions, when we say no limit, only to the extent that you have no limitations in place that would cap itemized deductions under the proposed plan. Those over $400,000 in earnings would start to recognize a cap of all itemized deductions at 28% of your income. So it's going to be a moving target depending on where your income is at. And so you may have itemized deductions due for interest and taxes and charitable contributions all be limited to 20% in total of your income as a result, where currently there is no limit. And lastly, it wasn't necessarily in his program, but there has been talk by the president-elect of changing the rules with respect to 1031 exchanges. We've heard, again, it wasn't documented, but potentially the ability for folks to do real estate transactions under Section 1031 could be gone. And some changes to the opportunity zones. Again, I don't have any facts with respect to those particulars, except to keep your eye out that there may be some potential changes in the future with respect to opportunity zones. Now, I remind you, our firm handles small business, high net worth individuals who own those small businesses and can help in any of these matters with respect to tax planning, consulting, or any matter relating to CPA services. So don't be shy to reach out if you have any needs. We open up the floor to any questions at this time.
Thank you so much, Frank. I do have a couple of questions, but let me open up the floor again. I know that when we are in a Zoom session, at least when I'm in my classroom, it takes a few more seconds for people to share their questions. So I'll take that 7-second pause and allow people to jump in. All right. One of the questions I have is in reference to the changes in the cost basis of a real estate property or anything that your heirs receive. Is it not true that if the state receives a property, there is an immediate evaluation of that property, and then taxes are paid, not real estate taxes, but state taxes are paid on any appraisal of that value at that time of the death. And so the new heir would then receive that property at the new basis without being exposed to further tax liabilities. However, it does force that payment at the time of death, which kind of forces that what some people refer to as the death tax. And so what will change then? If this is the case, then would this allow somebody to receive a business and not have to pay on the appraisal of that higher appraisal of that business or that property until they actually sell it?
Great question. I'll remind everybody that the first $11 million per heir is excluded from estate taxes. So we're talking about valuations that would be very large. So a husband and wife would have over $22 million of their estate would be sheltered from estate tax or death taxes, as you referred. And when we're talking about a taxable estate, it will be appraised at value at the date of death. And you get to deduct certain items against that taxable estate, such as the loans that are outstanding against those properties, loans within the business, and then any settlement of liabilities associated with the business and or properties that mean other than loans, and other expenses associated with the estate would also be deducted. So just really emphasizes the point that estate tax planning is necessary for those estates of a husband and wife that have assets or a net estate greater than $22 million currently. And one of the ways to mitigate that and to have cash available is to have life insurance policies to provide enough coverage to be able to pay the tax if the unfortunate death was to come. So the point here is, if you do have a taxable estate greater than the exemption, you do want to employ a estate strategy that allows you to plan for or have liquidity enough upon the second death of the estate so that that obligation can be paid. Is you don't want to get into a fire sale situation where you do have to liquidate properties or a business to be able to make that tax payment. One of the easiest strategies to be able to do that is to use insurance vehicles to cover your tax obligation.
Wonderful, wonderful. Any other questions? Let me continue opening the floor. I do have another question. It goes back to that question I asked for that PPP loan. And I think that some people actually utilize the disaster loans that are not PPP loans. And some family businesses actually apply for these loans once the $10,000 grant was already exhausted. And so at that point, they had questions as to whether they should go beyond that $25,000 loan size, which require them to have an actual insurance over their assets. It also required them to provide all of their assets as collateral for that loan. And some family businesses, to be honest, were hesitant to actually engage in the loan that was larger than $25,000, because then they felt that they would kind of be immobilized by the federal government in making any types of transactions as they release some of these assets. So if they had to collateralize their assets, they would not be able to sell without getting some kind of permission. So it complicated things in their mind. Can you speak a little bit to that effect and what you've seen in your practice with your clients, if this is the case indeed?
Yeah, so we've seen only very few idle loans taken advantage of during this time. And with respect to the restrictions and the collateral and the security that was required, that was quite cumbersome. And that we did see some folks not apply or go through with receiving the loan. And so we encourage folks to continue to work with their banker if they still maintain solid revenue streams and profitability, to utilize conventional financing to be able to accomplish their needs of liquidity, versus using the SBA loan for 30 years.
Thank you. I think that's important to know. There's a couple of other questions. Tara asks, what are some tips do you have for businesses documenting expenses effectively?
Yes, great question. We've seen the banks be quite picky. So some of the tips that we employed is providing detailed registers of your employees in Excel. Create a template that had all of the required information that, if you recall, on Schedule A of the forgiveness application, there was a template. Duplicate that template in Excel. Many of you had many more employees than were allowed to be documented on Schedule A. And then provide the necessary payrolls that support the dollar amounts that you utilized for each of the employees, and then show your calculations for those who had employees over $100,000. We found a lot of the folks getting tripped up in the bank, I want to call them auditors, who went through your file, could not match and come up to the same calculations for payroll as presented. And so we encouraged our clients to provide the calculations, especially if they had employees that were over the $100,000 threshold, to where you maximized that employee during the covered period over to a certain amount, and show the math. And so we found an Excel spreadsheet to help just take the question away from the reviewer of the loan. Also, provide bank statements during the covered period. We find that even though it's not necessary, they always came back and asked for the bank statements as support to see the disbursement actually hit the bank. They wanted to dot all the I's and cross all the T's. So I'm back to, the invoice that generated, say, the utility bill, PG&E. Well, how did you pay for it? With a check. Give them a copy of the check. Give them a copy of the bank statement. Highlight on it where it cleared the bank. That level of detail took away any of the questions we found that the bank examiners rustled up as a result of their review of the file. Great question.
Thank you. There are some more.
Great.
If we have filed all the forgiveness paperwork, what is the approximate time period before the loan is actually forgiven?
Boy,
Okay.
if you would have asked me that before October 4th, it would have been, I would have shrugged like this and said, banks went silent. And it wasn't until Secretary Mnuchin went on record on October 4th and said really that between the Treasury and the SBA, they monkeyed up the works and didn't allow the banks to give approval. And so the banks all sat tight without saying anything. Now we have found after that date that the process is taking about 6 weeks for bank review because they're slammed trying to get through all the applications. They've all come in, it appears to be all at once, and they're processing them as soon as possible. We have seen the SBA approval process to be quicker than the bank approval process. Remember, it's a two-step process. First, you get the bank questions you, tells you how much that they're going to recommend to the SBA. You get a chance to appeal. We have found with some clients that the bank calculated a less than full amount or a less than 100% forgiveness. And so I always encourage, go back and let's find out why, and question the examiner. Why did you reduce my forgiveness amount? Here are all my supported expenses. And I found in every case that they came back with detail because you didn't provide this, or we couldn't do this calculation, or we couldn't get to the same number you did. And so that's build the fact pattern to say, provide them with the math, provide them the bank statements, provide them all the level of detail of backup invoices, and take all of their excuses away to lowering the amount from 100%. And we found that to be the most effective way to get to 100%. So the next question I see is there a timeline when you need to file for forgiveness? And the timeline really revolved around the end of your covered period. So as soon as you completed your covered period, banks wanted you to apply, not a moment before. So the covered period started on the date that the loan or the proceeds hit your checking account. Then you would start the clock on either the 8-week or the 24-week covered period. As soon as that 24-week or that 8-week period closed, we highly recommend folks to get into the queue and get their application into the bank. That means along the way, as you're going along, start gathering the data, and let's get that in right away. The end of the covered period is coming up. So if anybody received a loan as late as August 8th, I think it was, you have until December 31st to complete the utilization of those funds. And immediately after, you should be starting the application process for forgiveness.
Wonderful, wonderful. I realized that I was muted before.
Oh, that's okay. I'm going to add another point on topic and remind everyone that currently the way the law is structured and the way the IRS has provided ruling in the last 3 weeks is that those expenses that you paid with the PPP funds, they're non-deductible on your tax return. Therefore, reducing some of the benefit that you received in the form of the PPP loan. Depending on which tax bracket you're in, you effectively reduces your benefit of the PPP loan or the grant. So there are legislators on both sides, in both houses and on both sides of the aisle that are feverishly lobbying for a bill to be cobbled up and presented for vote before the end of the year. And in that bill, among other things, where they're trying to provide stimulus to small business and to families, is to get these expenses that are considered currently to be non-deductible to be deductible. So keep your eye on the next 2 weeks, what comes out of Congress. And one of those items, with fingers crossed, will be that they included these expenses that were considered covered to be deductible.
And that was one of the questions that Jimmy Maxey had. How will PPP forgiveness be taxed?
Great question. The proceeds on the receipt of the monies was never intended to be taxed. So there will be no taxation for the proceeds. The amount of the funds that you spent, just as I mentioned, those covered expenses will not be deductible, effectively increasing your tax liability from your operations. But with any hope, as I mentioned earlier, there'll be some relief for small business as a result. So the PPP money is not taxed.
And that's the same for the other loans, right? The disaster loans, EIDL loans.
The 10,000 is, but the loan above and beyond 10,000 that's paid back over a period of the 30 years is not considered taxable income as well. So because you're paying that back, but the $10,000 is considered a grant as well.
Wonderful. So I guess the distinction here is, as long as it's free money, then whatever expenses you are actually covering with those funds are not going to be considered deductible, right? Since your money is being received tax-free, so are the expenses that are associated with those funds going to be taken away from your financial statements, if you will, in a tax, on a non-taxable manner. So, but if you are paying back a loan, the portion of the loan that you're paying back is indeed money that you are generating with funds that are paying taxes. Therefore, the deductions and the expenses you have associated with those expenses are indeed deductible.
Correct. Absolutely, they would be. So if a portion of your PPP loan was not forgiven, to the extent of the amount that was not forgiven that you paid expenses with it, those will be deductible. Those expenses will be deductible.
If you have time to entertain an additional question, there
Absolutely.
are some small businesses, very small businesses, that are sole proprietorships, and they qualify for the maximum amount of, let's say, $20,000 and some change, $20,800 for just income. And they don't normally have a paycheck or payroll. It was just their earned income, that was more than $100,000 a year, and now they suffer some uncertainty or displacement, and so as a consequence, they apply for the PPP loan. They receive the $20,000. Those funds are tax-free, but do you have to actually connect those funds with an expense, or is that considered a quasi-payroll, meaning just the bottom line of your net income in those cases where you have a sole proprietorship?
Great question. Quasi-payroll is an excellent word. So what I've told my clients who are sole props, that if they receive that amount, that just write a check out of your sole proprietor business checking account into your personal account. And that was the impetus for it to be considered a covered expense.
Even if they normally don't have a payroll.
That's correct. That's correct. They treated sole proprietorships different than they did those who were small business owners in an entity.
And I think that's some of the major questions. You know, a lot of small family businesses, they don't actually have a payroll. They just operate on their income. I'm sure you may have some recommendations for that approach. Nonetheless, that's the case. Another thing that I've seen is family businesses use, you know, their own checkbook and mix. When you're small, you mix your business transactions with personal transactions sometimes. So I guess in this case, just writing a check to your savings account would suffice.
You know, I suppose I think the spirit of the rule was that they were just trying to get money to sole proprietors as quickly as possible with very little handcuffs on them. And I'm not aware of any issues of relief with respect to the sole prop who intertwine their personal accounts with their business activities. At this point, I have not seen any or have any guidance that I've seen from the SBA.
Don't forget to get a business checking, guys. It's not that expensive.
I mean, I'd be highly recommended is to separate your business activities. I'll tell you from a CPA accountant standpoint, and Colby could vouch for this, is that at the end of the year, when we're trying to, you know, determine what your deductions are to be able to go through your personal checking account to find those, it's like finding a needle in a haystack. It's not, you're not doing yourself any favor from an accounting fee standpoint. And yourself trying to go through and itemize your own checkbook of this is business, this is personal. It just causes more time and effort. If you at a minimum set up a business checking account, of course it's in your sole prop name. It could be a fictitious name or whatnot, but you keep it separate from your personal checking account. And as you need to move over money, just write a check to yourself or transfer online.
Absolutely great. We have another question as well. If you receive any of these funds, are you allowed to prepay for rent?
So there was a lot of discussion regarding that, and you were able to prepay 1 month. So if your covered period was coming up, you were either going to be in arrears or you were going to be prepaid. At the end of the day, the covered period was effectively to cover 2 months of rent. That was the spirit of the act, was to cover 2 months of your rent.
That makes total sense. So, you know, whatever 2 months of rent, even if you have to accrue it instead of recognize it as a cash, depending on your accounting approach.
And they did come out with guidance to not be so stringent at first. Everybody was focused on being cash basis. Even if you were accrual, oh my gosh, I got to get this expense in by the covered period ending date, because usually it's due on the 1st, but my covered period ends on the 25th. I better write that check by, you know, so there was a lot of that went on. And the SBA gave guidance shortly after the beginning of the program that said, no, everybody calm down. We got a lot of questions about that. There was something called the alternative covered period that many of us, I'm sure, had seen, to where they said, yeah, you get to get some flexibility in your covered period to allow for these items that float just outside or just before the covered period.
So many great questions. Thank you so much for entertaining all of them. These are really pressing times for all of these family businesses, and we certainly thank everybody for attending this very, very educational session. Special thanks, Frank, and Colby, for sharing your wisdom with us. Do we have any other questions? All right.
Well, we'd certainly like to thank the small family board in inviting us to your presentation today and allowing us to share some of our knowledge with your fine membership.
Thank you so much. And thank you everybody once again for joining us today. We will go ahead and produce this video so that we can have this share with your friends. Obviously, if you have financial questions, you can always reach out to Wiebe Hinton Hambalek, who are experts in handling any of these questions, especially as you plan for 2021. It's been a pleasure to host you both. And thank you all. Let us know if we can ever be of service.
Thank you.
Thank you all. Have a great rest of the day and happy holidays for everyone.
Happy holidays.
Christmas too. Take care.
Merry Christmas.